Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special housing report. Today we're going to have a look at 5 key numbers that eventually move our economy, and particularly our housing sector, and bank lending. Now, they're not numbers you'd normally expect to see, the official cash rate or the Fonterra payout or the exchange rate. These are 5 numbers which I think eventually affect the way banks think about lending, and they affect interest rates long term. The first one is what I call the VIX, or the Fear Index. It's often referred to as the Fear Index. It's a measure of volatility, and there's actually an index you can trade in the Chicago futures market called the VIX. Now, when it's rising quickly, that shows that financial institutions and the markets globally are worried, and it shows that there's a lot of volatility in the market. When banks see that, they start getting worried too, and they start to be careful with their lending. The second one I want to have a look at is the credit default swaps for Australasian corporates. This is a measure of how risky the rest of the world thinks lending to Australasian corporates is. And when we say Australasian corporates, we're talking about the Australasian banks. And obviously our big 4 banks are owned by the Australian big 4 banks. And when that rate rise, the CDS rate for those Australasian corporates, that means the big Australian banks will find it just that little bit more difficult to borrow from the rest of the world. The third measure I want to have a look at is what's called the LIBOR OIS swap rate. Now, this is referring to the gap between the London interbank offer rate, the rate at which banks lend to each other in the international credit markets, and the overnight index swap rate. This is a measure of what the cost of cash money is, if you like. So it's the difference between the overnight rate between banks and the safest form of money, the cash rate. And that gap measures the amount of fear there is between banks and how risky they see taking out essentially bets on future returns from banks. That LIBOR OIS swap rate. That tells you how nervous the international financial system is and how much it's going to cost some banks to borrow from each other. The third measure I want to look at is New Zealand mortgage approvals. This tells you how much the banks are lending into the mortgage market every week, and it's quite fresh as a number. And you can see over the last year or so that number has been dropping quite sharply as the banks look to conserve their capital, and also the demand isn't there from many buyers as they see the housing market as overvalued. So we keep an eye on the New Zealand mortgage approvals. The next one we look at is the gap between the 1-year term deposit rate in New Zealand and the official cash rate. This measures how much the banks here are having to push to get term deposit savings from mums and dads to fund their lending. Remember, the Reserve Bank is pushing the banks here to get more of their funding from local term depositors. And the higher they have to push their rates, the higher their costs. And that rate has risen from around about 150 basis points over the official cash rate to about 260 in the last year. And that's pushed up funding costs for the banks, it's pushed up interest rates, particularly fixed mortgage rates. And the final one we're going to have a look at is between the 2-year fixed mortgage rate and the variable mortgage rate here in New Zealand. And you can see that has risen over the last year from around about nothing to about 120 basis points. In fact, it's moved up almost in tandem with that gap between the term deposit rate and the official cash rate. Now, don't get too flummoxed by all these numbers. What essentially all these sets of numbers show is that banks all around the world in the last couple of years after the Lehman crisis and the global financial crisis are being a lot more careful with their capital. They're reducing their leverage levels, and they're forcing New Zealanders, and in fact all the developed countries who had housing booms, to deleverage, to reduce the amount of borrowing they're doing. And they're doing it sometimes in very violent ways, as we've seen in the United States and the UK, or in slow, grinding ways, as we're starting to see here in New Zealand and in Australia, where the banks are being careful about their lending, interest rates are slightly increasing, people realise they've got too much debt and so they're not borrowing more. And this all means we're not seeing the sort of credit-fueled growth in the housing market that we saw in previous years. So there we have it, 5 key numbers to watch when you're thinking about the housing market. I'm Bernard Hickey. That was a special report brought to you in association with the BNZ.